On January 23rd, 2025, the financial media popped the champagne. The S&P 500 closed at 6,118, an all-time high, a mathematical monument to American prosperity. They told you the bull market is invincible. They showed you the green candles and told you to buy the dip. But pause for a second. Take a look away from the ticker tape and look at your grocery receipt. Does it feel like you are living in a booming economy? Do you feel 25% richer than you did last year? There is a terrifying disconnect here. And if you look at the raw data, the signal starts to bleed through the noise. Consider the misery index, the simple sum of inflation and unemployment. As of early 2025, official unemployment sits at 4% and headline CPI came in at 2.9% for December. On paper, a combined score of 6.9 looks manageable, but that is the illusion. That 2.9% inflation isn't a price drop. It is a new layer of concrete poured on top of the cumulative price spikes of the last 3 years. Prices didn't go down. They just stopped sprinting away from you quite so fast. So why is the stock market screaming at 6,118 while the average family is drowning? This is not a bull market. This is what Ludwig von Mises called a crack-up boom. In a crack-up boom, the stock market doesn't rise because companies are producing more value. It rises because the currency used to measure those companies is collapsing. Think of it like a ruler that is shrinking. If your yardstick becomes 6 inches long, suddenly the room looks twice as big. The S&P isn't growing. The dollar is shrinking. This is why your portfolio looks like a rocket ship, but your purchasing power looks like a crime scene. They call it an all-time high. But when you strip away the illusion, it looks a lot less like a celebration and a lot more like a getaway car. Do you remember the receipt? Stand there for a second. Back in the checkout line, you watch the conveyor belt move. Milk, eggs, ground beef. In 2019, a single $1 to $100 bill filled the cart. It bought you 5 heavy bags. It bought you security for the week. Now look at December 2025. You hand over that same $100. But when you look down at the cart, the bottom is barely covered. The Bureau of Labor Statistics released the numbers this month. They claim your grocery bill is stabilizing. They point to an annual food inflation rate of 3.1%. Do you believe the chart? Or do you believe your eyes? Because the math tells a different story. According to the data quietly buried in the back pages to replicate that 2019 shopping trip, you now need nearly $120. And that is using their generous averages. Real life is sharper. In 2019, that $100 could buy you 17 dozen eggs. Today, with prices spiking 24% this winter alone, you'd be lucky to walk out with 9. Ground beef hasn't just gone up, it has surged 35% in 6 years. The official data says you lost $18 of purchasing power. But the empty space in your refrigerator says you lost something else. You lost time. Think about how long you worked to earn that $100 in 2019. Maybe it was 3 hours, maybe 4. Today, you are working the exact same hours for 20% less survival. This is the glitch. When they tell you inflation is cooling, they are gaslighting you with statistics. They haven't fixed the leak. They've just stopped measuring the water rising around your ankles. That $100 bill wasn't spent. It was diluted. And those 2 bags of groceries you didn't bring home, that isn't inflation. That is the tax you paid for their exit strategy. Close your eyes for a second. Imagine a stock market that hits a new all-time high every single morning. The cafes are full. Champagne is flowing in the cabaret halls. Everyone you know is making money hand over fist. You check your portfolio and you feel smart. You feel safe. That wasn't New York this morning. That was Berlin. October 1921. They called it the Times Katastrophenhause asterisk, the catastrophe boom. The Germans thought they were getting rich, but their stock market wasn't rising because companies were innovating. It was rising because their money was dying. Now, look at your phone. As we entered January 2026, the S&P 500 smashed through yet another record ceiling. The media calls it a bull market. They tell you the pivot is working, but look closer at the engine. In the last 12 months alone, the United States added nearly $4 trillion to the national debt, pushing the total past $36 trillion. That isn't economics. That is a structurally impossible math equation. Why do you think gold shattered the $2,600 ceiling and kept climbing? Do you think that's a coincidence? Gold isn't going up. The dollar's going down. Just like the mark in 1921, we are living through the greatest illusion in financial history. The wealth you see in your brokerage account is just the fever flush of a dying currency. The Germans of 1921 partied right up until the moment the music stopped. They didn't see the cliff. Do you? You open your brokerage app, all-time highs, green arrows everywhere. It feels good, doesn't it? Seeing the number go up? But ask yourself a question the history books usually skip. If the economy is crumbling, if the supply chains are snapping, and if nobody can afford rent, why is the stock market exploding? The Germans have a word for this. Asterisk. Katastrophenhause. Asterisk. Translated? The catastrophe boom. In 1923, right before the Weimar Republic turned into a graveyard of wealth, the German stock market didn't crash. It soared. It went parabolic. Millions of percentage points in gains. But listen closely. The companies weren't producing more. They weren't innovating. They were dying. The stock market wasn't measuring value creation. It was measuring currency destruction. By November 1923, you needed 4.2 trillion marks to buy a single US dollar. If you had owned stocks, you felt like a genius on paper. Nominally, you were a trillionaire. But in the real world, that entire portfolio couldn't buy a loaf of bread? This is what a currency collapse looks like in the beginning. It doesn't look like a red line going down. It looks like a green line going up forever. So look at the S&P 500 today. Is that growth? Or is your money just panicking, trying to find a place to hide before the music stops? The chart isn't telling you how rich you are. It's screaming a warning, and you are mistaking the fire alarm for applause. They told you it was the supply chain. They told you it was greedy corporations. They told you it was transitory. Does that sound familiar? Before you check your portfolio, I need you to meet the man who invented that script. His name was Rudolf Havenstein, president of the German Reichsbank. He wasn't a chaotic revolutionary. He was a serious man in a stiff collar, a technocrat, just like the ones running the Federal Reserve right now. In 1923, while the price of a loaf of bread was doubling every few days, Havenstein stood before the German parliament and denied that printing money was the problem. In fact, he was proud of his efficiency. He announced on the record that his bank was issuing 20,000 milliard marks daily. He promised to ramp that up to 46,000 milliard by the following week. He didn't see this as an economic suicide note. He saw it as a stimulus to help businesses cope with rising costs. When the currency collapsed, Havenstein didn't look in the mirror. He pointed at the speculators. He pointed at foreign debts. He pointed at supply bottlenecks caused by the war. He kept interest rates at 5%, while inflation was hitting 100%. Does that math scare you? It should, because when you hear modern central bankers talk about supply shocks or blame inflation on a war in Europe, you are listening to Havenstein's ghost. He truly believed he was providing liquidity to a thirsty market. He didn't realize until it was too late that he was drowning them. You followed the rules, didn't you? You worked the job. You filled the savings account. You bought the safe government bonds because they told you it was the responsible thing to do. But history has a cruel sense of humor. In 1923, Weimar Germany, the poor didn't suffer the most. They had nothing to lose. The ultra-rich didn't suffer either. They owned factories, forests, and gold. The victim was the man in the middle, the rentier, the saver, the man who traded a lifetime of labor for a stack of government paper only to find out that paper was fuel for the fireplace. Do you think that's ancient history? Look at the ticker on your screen. Gold didn't just cross $4,550 an ounce in late 2025 to make headlines. That vertical line on the chart isn't a profit. It's a scream. It is the sound of capital fleeing the burning building of the sovereign bond market. When gold moves 70% in a single year, it's not because the metal changed. It's because the currency you are pricing it in is dying. We are now witnessing the crack-up boom. Notice how people are spending lately? Buying cars they don't need, renovating houses they can't afford. They aren't buying because they are rich. They are buying to get rid of the cash before it rots in their hands. They know subconsciously that the game is up. The death of the rentier class isn't coming. It's already here. And that nest egg you spent 40 years building? It wasn't lost. It was transferred. Most people are looking at the stock market. They're watching the S&P 500 hit new highs and thinking everything is fine. But if you turn your eyes to the books of the United States Treasury, you'll see something that should terrify you. It's a chart that's gone completely vertical. For decades, the cost to service our national debt was a boring flat line, a nuisance. But look at what just happened in 2025. According to the Federal Reserve's own data, the annualized interest payments on federal debt just shattered the $1.2 trillion mark. Numbers that big usually don't register in the human brain, so let me put it in terms that will make your stomach turn. For the first time in American history, we are now spending more on interest payments than we spend on our entire national defense. Think about that. The aircraft carriers, the fighter jets, the bases in 80 countries, the salaries of every soldier, sailor, and Marine, the greatest military machine the world has ever known, is now cheaper than the cost of our own credit card bill. Do you realize what this means? It means the era of choices is over. When you pay more for past mistakes than for your own security, you have crossed a mathematical event horizon. We are no longer borrowing money to build roads or fund schools or even to fight wars. We are borrowing money just to pay the interest on the money we already borrowed. This is exactly how a Ponzi scheme collapses. Not with a whimper, but with a parabolic line that screams one thing: insolvency. They tell you the dollar is strong. They tell you to keep your savings in the bank. But have you looked at what they actually do with their own money? While Western media was telling you gold was a barbarous relic, central banks were quietly engaging in the most aggressive buying spree in human history. Look at the numbers. In 2024 alone, central banks swept up a record-breaking 1,044 tons of physical gold. And in 2025, that hunger didn't stop, it accelerated. Here's the divergence that should keep you awake at night. For months, Western retail investors were selling. ETF outflows drained gold from London and New York vaults. The average citizen was dumping real assets for paper promises. But who was on the other side of that trade? Who was buying every ounce you sold? The East. The sovereignty-obsessed elites. The central bankers who know exactly what they have done to the currency. We aren't seeing a market fluctuation. We are watching a wealth transfer. Gold didn't just cross $3,000 an ounce because people like jewelry. It skyrocketed because the people who print the money are terrified of their own printer. They are hedging against the very collapse they engineered. Think about that. The captains of the ship are putting on life vests while telling the passengers to enjoy the buffet. This isn't investment advice. It's an intelligence briefing. They have their exit strategy. Do you have yours? They told you they were tapping the brakes. They told you the adults were back in charge. But look at the chart on your screen. Do you see that red line crossing the blue one? That is the moment the United States officially began spending more on interest payments than on its entire national defense. Think about that. We are spending more to service the bankers' spread than we are on the Army, the Navy, and the Air Force combined. This is what economists call fiscal dominance. It means the Federal Reserve is no longer independent. It is captured. Jerome Powell can't raise rates to fight inflation anymore. Because if he does, the interest on the debt hits $1.6 trillion and the United States government goes insolvent. So what do they do when they are trapped? They cheat. While they told you they were doing quantitative tightening, they were secretly opening the back door. Look at the reverse repo facility. 2 years ago, this account held over $2.5 trillion. Today, it's being drained dry. It was a stealth slush fund. They took that liquidity and injected it right back into the veins of the market to stop the patient from flatlining. Do you really think they fixed the problem? Or did they just burn the furniture to keep the house warm for one more winter? When the reverse repo hits zero, there are no more tricks, no more slush funds, just the printing press and the fire. Look closer at the skyline of your city. Take a walk downtown. Look at those glass towers that used to symbolize American power. What do you see now? For lease signs, dark windows at 8 p.m., you are looking at a graveyard. Most people walk past these ghost towers and think it's just a sad side effect of working from home, but they are missing the invisible wire attached to the dynamite. In the second quarter of 2025, the U.S. office vacancy rate hit a record-shattering 20.7%. Think about that. More than 1 in 5 offices are completely empty. If you were a landlord, could you survive if 20% of your income vanished overnight? Of course not. You would default. And here explains why the system is trembling. These landlords didn't buy those towers with cash. They bought them with cheap debt that is about to expire. We are staring down the barrel of a $1.5 trillion maturity wall by the end of 2026. That is $1.5 trillion of loans that must be paid back or refinanced. But here is the trap. They cannot refinance. Not when interest rates are higher than they were 5 years ago. Not when the building is 20% empty. Not when the asset is worth less than the loan itself. So who holds the bag? Check your debit card. Regional banks hold a massive concentration of this toxic commercial debt. They are sitting on billions in losses that they are hiding with accounting tricks, extending the loans, pretending they will be paid back. Extend and pretend. That's the official strategy, but you cannot pretend forever. When $1.5 trillion comes due and the vaults are empty, the illusion breaks. Gravity inevitably takes over. And when the regional banking system screams for help, do you think the Federal Reserve will let them fail? Or will they do the only thing they know how to do? They will turn the printers back on. They will dilute your currency to save their donors. The empty offices aren't just a real estate problem. They are the signal that your money is about to die. They call it the Wile E. Coyote moment. You know the scene. The coyote runs off the cliff. He keeps running on thin air. He is fine until he looks down. Right now, the global economy is hovering over that canyon, and everyone is refusing to look down. Because if you look at the math, you realize the ground disappeared a long time ago. Just check the latest numbers from the Treasury. As of 2025, the U.S. national debt didn't just climb. It exploded to $37.6 trillion. That number is too big to understand. So let's make it real. While you are watching this video, the debt grew by nearly $70,000 every single second. Does that sound sustainable to you? For the first time in history, the United States is now spending more on interest payments than it spends on its own defense. $970 billion just to service the debt. Think about that. We are paying bondholders more than we are paying the Army, the Navy, and the Air Force combined. We aren't a superpower anymore. We are a giant insurance company with an army it can no longer afford. And the cliff edge, that's the debt to GDP ratio. We are sitting at over 125%. The economy isn't growing fast enough to outrun the interest. It's physically impossible. It's basic arithmetic. So what happens when the coyote looks down? The central planners have only one move left. They cannot default on the debt that would end the world. They cannot raise taxes enough to cover it that would end the economy. So they must choose the third door, debasement. They have to print the money to pay the interest. They have to dilute your savings to keep the illusion alive for just one more day. It's not a policy error. It is a mathematical inevitability. Gravity is kicking in, and the fall is going to be a long one. They call it the soft landing. But if you look at the raw data from the Treasury this week, you'll realize the runway is gone. As we crossed $38.5 trillion in national debt in early 2026, something fundamental broke in the machine. Do the math with me. When the government carries nearly $40 trillion in debt, they cannot afford real interest rates. If rates stay truly restrictive to fight inflation, the interest payments alone consume every single tax dollar collected by the IRS. No military, no Social Security, just interest. So what do? They don't have a choice. They have a directive. Top economists are already whispering the phrase fiscal dominance. It sounds academic, doesn't it? Safe? It's not. It means the Federal Reserve stops fighting inflation and starts fighting bankruptcy. They will implement yield curve control. They will print trillions to buy their own bonds, artificially forcing interest rates down to 2 or 3%, even while real inflation rips past 6, 7, maybe 10%. They did this in the 1940s to pay for the war. They're doing it now to pay for their mistakes. Think about what that means for the money in your pocket. To keep the government solvent, they have to sacrifice the currency. They are choosing to burn the value of your labor to save the value of their bonds. Gold hitting new highs wasn't a bubble. It was the market sniffing out the exit strategy. They will lock the rates down. They will let the cost of living run hot, and they will call it stability while your savings melt away in real time. Math is a cruel master. Eventually, the equation surely balances. The only question left is, on which side of the ledger do you fall? They call it the great wealth transfer. When you hear that phrase, you probably think of billions passing from boomers to millennials. But that is a distraction. The real times transfer isn't happening between generations. It's happening between you times and the state. Look at the numbers released for fiscal year 2025. For the first time in history, the United States government spent more on interest payments than on national defense. $970 billion just to service the debt. That is $53 billion more than the entire military budget. Think about what that means. The government is mathematically insolvent. They cannot tax you enough to fill a $1 trillion hole that grows every single year. So do you think they will declare bankruptcy? Do you think they will admit the system is broken? No. That would destroy them asterisk. Instead, they choose the silent default. They choose inflation. This connects the dots to what you feel every time you swipe your card. Inflation is not an accident of the market. It is a mechanism. It allows the state to pay back its massive debts with worthless currency. It wipes the government's slate clean. But a debt doesn't just vanish. It has to be paid by someone. And that someone is you. Every dollar lost from your purchasing power is a dollar transferred to their balance sheet. Your savings are being liquefied to keep their ledger alive. The middle class isn't just suffering through this crisis. The middle class is times financing times it. Gold at record highs isn't a bubble. It's the sound of the exit doors slamming shut. The transfer has already begun. And you are on the wrong side of the transaction. Most people look at their banking app and see a number. They think that is their money. It isn't. It is an unsecured loan you made to a bankrupt institution, and the entity guaranteeing that loan, the United States Treasury. Look at the data we just pulled for the third quarter of 2025. The federal government is now burning $1.2 trillion a year just to pay interest on the debt. Do you understand what that number means? Interest is now the second largest expense in the entire budget. It has eclipsed the defense budget. It has eclipsed Medicare. It is chasing down Social Security. The system is mathematically insolvent. And your bank deposit is tied directly to that bleeding beast. This is what we call counterparty risk. You are betting your life savings that a politician won't print your purchasing power into dust. You need to stop playing their game. You need to move to bearer assets. Assets that have no liability, no CEO, no board of directors. Gold didn't just break $2,600 an ounce because it's shiny. It rose because the smart money is fleeing the dollar. Bitcoin isn't just tech. It is the only ledger on earth they cannot edit. Land, silver, things you can touch, things you actually own. If you hold it physically or in cold storage, you become the CEO. You become the vault. Become your own central bank. Because the real one, it's already closed. They told you the system was robust. They told you a soft landing was guaranteed. But look at the Treasury report released for fiscal year 2025. Do you see the structural fracture? For the first time in American history, the United States government is spending more to pay interest on its debt than it spends on national defense. Think about what that means. We are no longer borrowing to build bridges or fund armies or cure diseases. We are borrowing nearly $1 trillion a year just to keep the lights on in the casino. The Congressional Budget Office projects a $1.9 trillion deficit for 2025 alone, not because of a war, not because of a pandemic, but because the math has finally broken. Why do you think gold has been shattering all-time records? Gold didn't just get expensive. The dollar got sick. Smart money isn't investing anymore. They are exiting. They see the sheer velocity of the debt spiral, and they know exactly how this story ends. The currency has likely entered its terminal velocity. There are no more tools left to fix this. No more interest rate cuts can stop a solvency crisis. No more printing can hide the inflation. The only variable left is time. Look at the paper in your wallet. Really look at it. Does it remind you of anything? Because history doesn't just rhyme. It demands payment. I hope you like it. If so, subscribe to the channel.